Good afternoon, everyone, and welcome. I'm very pleased to have so many people logged in today. We're going to run through employee share ownership plans, give you a bit of an overview, and very happy to answer questions on the way through. For those of you that haven't used Teams before, it's very similar to most of the other online meeting platforms. There's a little chat dialogue box that you should be able to see up on the right-hand side of your screen. I can see messages coming through there, so if there are comments, questions, or things you'd like to go over, questions you've got to ask, etc., please just type them into that box. I'll keep a close eye on that as we go through, and I should be able to make sure that I can answer those on the way through for you. Let's get into the presentation. I'm going to go through a bit of background information on employee share plans, some of the thinking we've got around how and why they work in mid-market businesses, and then happy to have a bit of a discussion and answer some questions on the way through as well. Just a quote to start with. Sir Stuart Hampson was formerly the chair of the John Lewis Partnership, a very large employee share ownership plan out of the UK. Those of you that are familiar with John Lewis will know it's a large chain of grocery, homewares, department style stores, a number of different brands in the group, but it's entirely owned by employees. So there's about 81,000 employees in the John Lewis Partnership Group, and they all own shares in the business. And Stuart Hampson here, the thing that I like about this quote is really talking about competitive advantage in both good times and bad. I'm going to run through three key things today, starting with the ladder to equity, a model that will outline for you how we progress employees through a chain from income through to equity. Then we're going to talk a little bit about employee mindset and how do we get employees to think and act like business owners? What is it that we can do that encourages them to be a little bit more ownership focused than employee focused? And that's a gradual transition. It doesn't happen overnight, but it's certainly something we've seen work very, very well with clients. And then I'm going to talk technically a little bit about, without going into too much technical detail, but a little bit of background information around employee share ownership plans. What types are there? How do they work? How does the tax work? What do the things look like in terms of legal requirements? Let's start with the ladder to equity, because that's the basic model that underpins everything. It's a quote from Warren Buffett, and it talks about the fact that employees are keen to climb the ladder to equity, but someone needs to provide the ladder. There needs to be a structure that enables employees to move through this process. Of course, the place that we start, the place that most employees start and often finish their working careers, is as an employee earning an income. And that model is generally either a fixed salary, a weekly wage, or even an hourly rate, where we simply turn up 9 to 5 typically, as the old saying goes, and we get paid for that. And that model's been around for many, many hundreds of years, and let's face it, it works. We don't need to change it too much, but there are certainly some things we can do to improve that model and the performance of that model. That remuneration model is really just focused on being there, and that's okay, but it's not great. So let's have a look at how we might tweak that or improve that over time. The first thing is to boost income based on performance, and that's very common with bonuses and sales commissions. Often you see, for example, real estate agents typically earn a very low salary. $40,000, $50,000 might be their fixed income component. The balance of their earnings is then tied up in commissions. If they sell a lot of property, they make a lot of money. If they don't get the extra commissions. That model is also okay, but again, it's got some issues. The main one being, well, there's two actually. The main one being it's entirely individual performance based, and that's sort of okay, but it discourages teamwork. And in fact, we've seen instances where salespeople within the same organisation actually compete with each other because of the way that they're paid. And so that's not a great focus. The other major issue with income-only type models is they're often based on gross revenue. When they're based on gross revenue, we see often some sorts of bad sales behaviour. People bringing orders forward from next month into this month because they know they're going to reach their bonus. Then they might hold orders back into the next quarter because they haven't met the bonus for this quarter, so let's bank them next quarter to make sure we get the bonus there. None of those behaviours fantastic for the business. The same as discounting. If you want to increase sales, often salespeople will introduce a discount or some kind of terms arrangement, and that's okay to increase sales, but it's not fantastic normally for profitability. So some of these models really don't work particularly well and can actually create incentives towards bad behaviour. And that's why we recommend generally moving at least to this step, which is step 3 of the process, to a profit share plan. Profit share does 2 key things. Firstly, we're no longer focused on individual performance. We're now focused on team-based performance. What does the group as a whole achieve in terms of performance and sales and incentive overall? Importantly, profit by definition also includes expenses. And so now we start to see an issue where employees can actually start to think about the costs and expenses incurred to run the business, as well as just driving gross revenue. And that would be hopefully much the same thing as what the owners should be thinking about as well. Now, the main problem with profit share is timing. Depending on how you measure this, and we've seen companies that might measure it over a month or a quarter, sometimes over 6 months or even a year, they're all still very, very short time frames. So sometimes we see people trying to do things like rolling profit over a 3-year cycle. Again, it's a very difficult thing to measure properly, and it's a difficult thing to get right. What we need to create is some kind of long-term incentive plan. And in my view, the best way to do that is equity. Equity is actually about building value in the asset or the business that we work for. And typically, building equity in businesses is not a short-term thing. It typically takes 3, 5, 10, even longer years. And so if we can get employees onto this equity model where they're starting to think about not just income, and when you own equity, you do get income because it's dividends, but also equity. How do we build the value of the business long-term? What about capital gains? How do we make the business more valuable over an extended period of time? And again, that could be 3, 5, 10, even 20 years if we're thinking about it properly. The last step on the ladder to equity, a lot of businesses don't actually get to, but realistically, everybody needs to get to this at some point in time. If you own a business, at some point you need to hand over control. Hopefully, not when they wheel you out in a coffin, but hopefully well before that in a managed and controlled and orderly fashion where you can actually plan and manage the transition of control yourself rather than let it happen to you at a later date. That's quite an important step for most business owners to start to think about. So we move through that ladder step by step. There's 5 steps in the process: income, then the advanced income profit share, then the equity, and then ultimately some sort of control mechanism. That process could take 1 or 2 years to work employees through that model. It's not something we're going to introduce bonuses, then a profit share, then an equity model, then control within 6 months. That's never going to work. It's a slow, gradual transition. And in fact, in some cases, the slower and more deliberately that it's introduced, the better the outcome. Now let's look and talk about ownership mindset for a second, just to make sure we're clear on what that actually means. It's quite difficult to get employee engagement right. And you'll see many, many articles, experts, blog posts, LinkedIn posts, you name it, around employee engagement. And look, lots of them have got very good ideas, but it's not as simple as just changing one thing in the business or running a workshop. This is actually a process, and it's more about education than anything else. Ultimately, the goal or the outcome is to get our employees to think and act like business owners. How do we get our employees to approach the business the same as we do as an owner? And there's 4 sort of components or stages to doing this. Firstly, you've got to get the right people and you've got to have them in the right jobs. Now, lots of people say that, but it's vitally important because the rest of it doesn't really matter if you haven't got that part right. Secondly, we need to educate and train our people around 2 key areas. Firstly, knowledge. And this is not, if you're in an air conditioning business, this is not the technical aspects of how you repair or install air conditioning units. This is about how the business works and how it makes money. How does it financially perform? What are the drivers to profitability and success in that business? Because most employees, if they're in that air conditioning business, they're probably there because they're a very good air conditioning mechanic or electrician or whatever it might be. They're not typically going to be there because they've got an MBA. And even if they have, do they really understand exactly what makes the business work financially? How does it become more profitable? How do we tweak that performance? And then secondly, what do we measure? What systems do we need to put in place? What KPIs do we need to look at? What dashboards do we need to design to ensure we're measuring and performing against the things that actually really matter in the business? Stage 4 then is actually fairly easy once we get through those 3, and that is, how do we incentivize that behavior? How do we design an incentive plan that actually matches that behaviour. And that's where a lot of incentive plans go wrong. Firstly, if we've got an ownership mindset culture, we're generally able to retain employees a lot better. People love being involved at work. There aren't many people, there's certainly not a lot of people that go to work thinking I'm going to do a really bad job today. There's very few people that go to work and think I'm going to be bored out of my brain for the next 8 hours, isn't that great fun? People want to be involved, they want to be engaged. Most people like to and would like to work for a company that is successful, that is doing well, that is making money. And so it's about showing them how they can do that. The education piece, as I said before, is around decision making, around the financial performance of the business. Discounts versus commissions, rebates, how do we sell more product? How do we improve our quality control? What are the key things that our customers are looking for? And where, in fact, within the business are we wasting money? Things like debtors days become vitally important for employees to understand the role they can play in moving that needle. How can they improve that particular metric? And importantly, what effect will that have on the business overall, if any? This is a model that came out of Mitsubishi Motors in Japan. It's called the iceberg of ignorance. And it talks about the fact that most problems in a business are known by the employees, but they're not known by high level senior managers. The CEO or the production manager may not know all of the issues within a business. And that seems quite simple and logical to most people. The problem is we don't do anything about it. We really need to get down to the frontline people. Who's dealing with our customers? Who's packing our orders? Who's managing our warehouse? Who's looking after our quality control? Who's doing our buying overseas, if that's what we do? It's really about understanding what's going on right throughout the business and where can we make improvements. The important quote there, what your employees don't know can hurt you, is actually really important. It's important to understand the impact employees can have and the knowledge they already have around your business and how it's performing. The next step then is to track that. What do we measure? What do we actually keep score of? And the problem we've got in most businesses is if we're entirely relying on financial statements, they're very complicated. They're long, they've got pages and pages of figures, and actually quite a few of those numbers don't mean anything. In as much as you can't do anything about them. If you've got a fixed lease for your premises for the next 3 years, telling employees how much you pay for rent is not really going to do a lot. But explaining to them how much you waste on postage because outbound goods haven't been addressed properly is something, A, they can understand, measure, and do something about, and that's the important connection. So we want to have a look at what we measure. And importantly, there are measurements in a business that are forward-looking, not lagging. So most financial metrics, even if we have the world's best bookkeeper and we get our March P&L on the first day of April, we can't do anything about March in April. It's already finished. What we can do is start to look at and think about what we can do in April and May. What do we measure that tells us what the business performance might be likely to do during April, May, and even June? They're called leading indicators. They're things, it's a little bit like trying to drive the car through the rear view mirror. It's never going to work. What we need to find is, what are the indicators that will give me some predictive ability around what's happening in the business going forward? This is a typical scorecard that we use with clients. You can see here, we're tracking some of the basic financial metrics for the business. Sales, gross margin, overhead. We're tracking the key things that matter in the business so we can understand what the performance is. Now, we're also tracking some more unusual things here. New client sales. Importantly for this business, it was one of the targets was to actually grow sales from new clients, not just the existing clients. And so we measure that separately so that people can see what are we achieving there. We also measure the percentage of non-owner sales and our debtors collection days. All of those are key metrics. Now, they might be an issue where perhaps this is a business that's been around for a long time and the owner still is the major salesperson. That's a risk in any business. So we want to try and address that. The best way to start addressing it is measure it and then start to look at strategies and tactics we can employ to improve that over a period of time. Now, the reality is we look at a lot of incentive plans. A lot of them don't work. And they don't work because they're pretty badly designed and they don't map back to the performance metrics we're actually trying to change. So let's have a look at some of the things that don't work particularly well in incentive plans, and then we can talk about what's important to make sure your incentive plan works well. Firstly, anything that's discretionary or where we change the goals halfway through does not work. It simply cannot work to give people a bonus at the end of the year and hope that they make some connection between the bonus they received and some performance or some KPI they achieved throughout the year, even though they don't know what it is. Discretionary bonuses have been around for a long time, but they don't work particularly well. The other thing that's really important is that we've got achievable, attainable goals, but people like to have a stretch goal. People like to actually strive for something and look to achieve it. And lastly, it's got to be something that's linked directly to workplace behaviour. What is the thing we're trying to improve? Is it quality of our product? Is it delivery times? Is it debtors days? Whatever it is, that needs to be mapped into the incentive plan, or we're never going to have any chance at all of affecting that performance. So if we summarise that into what works really well in an incentive plan, firstly, it must be self-funding. Those changes that we're talking about making in the business must offer some kind of improvement in performance and therefore drive value. We must have shared targets and understandable goals. People must know what they're aiming for and they can't be changed, and everybody needs to be aware of that. Stretch goals are good, but they need to be attainable. It's no good telling people we're going to double our sales in the next quarter when that's never happened before, and it's not likely to happen in the next quarter either. People will not even try to achieve it if they know it's not possible. And lastly, as I said before, we need to align employee behaviour to the business objective. Most employees are very happy to work in a business and to know what they need to do, but if we can align the behaviour of the employee with the business outcome we're looking for through the design of the incentive, we've got a much better chance of making it work. The way that we do that, when we implement an ownership mindset program, we start with a staff survey. We talk to people and ask them what's working well in the business. Where do you see issues? What do you understand about the financials of the business? We actually ask them to respond to a survey online. It's anonymous, but we then compile the results, put them together to get a bit of an understanding of what's happening inside the business. We also do some financial review, and then we look at educating people through a workshop around financial literacy. What do you understand about the business? How does the business actually work? What's this process of a rapid improvement plan? If we've got a problem with our debtors days, for example, let's set up a project, a short, sharp, concise project with one outcome: bring our debtors days down. Get everybody involved, find out what the issues are, do a survey, talk to the employees, and it's not just the accounts people, talk to our sales people. Talk to the people that sign up new customers. How do we engage them around terms and payment conditions, etc.? Who does the credit checks? When we send out an order, where does the invoice actually go? Do we email a copy as well as physically send it with the goods? Do we quote the purchase order number on the invoice, or do we just hope they can match it all up? What follow-up process have we got in place? Do we send statements? Do we ring them with a reminder? How does all of that work to make sure we can actually improve the process? And then ongoing, it's around follow-up and making sure this becomes an integrated way of owning and managing the business to make sure staff and owners are working together to implement these rapid improvement plans, monitor the scoreboards and make sure something's actually happening. Now, we've done several of these and I thought it'd be worth just showing you a couple of case studies. NPG Mining up in Newcastle, we set this program up quite some time ago. They had an interesting problem. They were doing a lot of work on underground coal mining machinery. A lot of that required overtime. So the mine does not want that machine out of the ground for too long. So the electricians would work on that machine sometimes until late in the afternoon or even evening, and then send it back down underground, which was great for the client. The problem was the electricians were building up a fairly substantial amount of overtime and then looking out on a Friday morning and saying, well, it's a great day, the surf's up, I'm going to go surfing. Because they didn't need the extra pay from Friday. They often took unpaid leave on the basis that they'd already earned a stack of overtime that week. So it's really about understanding what that component was, what that was doing to the business, what that was costing in terms of clients, but also working out how do we design a structure that's got a win-win component? How do we make sure the business is better off, but also the employees? Since we implemented that program, absenteeism has dropped by about a third fairly quickly after we did that. There's a quote from one of the directors just talking about their pathway to retirement using ownership mindset as part of that program to get pretty clear on what it actually looks like. Then we've got a very different business, a business based in Melbourne in Victoria. We worked with these guys late last year. We found and really workshopped through the process of finding out what the key issues were within the business, providing some efficiency and productivity, bit of accountability, and engaging staff to work together across different departments. And that was really around identifying who would run these projects. It shouldn't be the owner or the general manager. It needs to be internal within the employee group to drive the results and make sure that people are accountable. Once we've done that, and I think it's important to understand that's a really important component of introducing an employee share plan. It doesn't work anywhere near as well if you just jump to the employee share plan. But let's have a look at the employee share plans, how they work, and some of the design aspects that we put in place to sort of tweak and improve the performance over a period of time. Really, the summary here is we're trying to provide a mechanism where employees can own equity in the company they work for with the express intention that they will think and act like business owners. How do I get, and I don't know how many people work for you, but you imagine if you've got 20 people and let's say 6 or 8 of them were in an employee share plan and they thought and acted around that business the same way you did as an owner. You can imagine the improvement in performance you would see. We're seeing employee share plans coming into place for a number of different reasons. Several of our clients are selling their business to an employee share plan. That's becoming far more popular for a whole stack of different reasons, but it's becoming a good way for business owners to gradually and slowly exit, maybe over 5 or 10 years, and gradually at the same time bring in their employees, educate them and upskill them to run the business, gradually sell down equity to them, and therefore transfer ownership over a period of time. They're also important if you're looking at externally selling the business to just lock in and retain your key people. One of the biggest risks from a buyer's point of view is the key people within the business. How likely are they to stay, and how do I know if they're locked in? The other improvements are generally around business productivity. Most of the companies, in fact, I can't think of anyone who hasn't had some improvement in terms of productivity, employee engagement and retention, all of which add up to profit at the end of the day. If we can lock our employees in, engage them better and help them to be more productive, generally speaking, you'll have a far more profitable company. The last point is important for business owners to think about. It's a great mechanism, fairly tax effective, to extract cash from the business prior to an exit or retirement event. Interestingly, the research is fairly clear on this. Companies with employee ownership, they generally have faster growth, they survive longer, and they certainly survive during hard times better. They attract better paying customers and generally better employees. But interestingly, it's not about, because they rip off their employees, they actually have better and happier workplace cultures, and generally their employees are better off over a period of time. Interesting comparison just on staff retention. This is data from Computershare research here in Australia a couple of years ago. In an employee share plan company, employees typically stick around for an average of 9.69 years. In non-ESOP companies, 5.5. So it's not quite half, but it's pretty close to that metric. It's substantially different. This is the one that I like, research out of Rutgers University, talking about the benefits of employee ownership. But it's important to understand this also talks about high participation, high performance policies. So some of the ownership mindset thinking coming into play here. But they're seeing performance increases from anywhere from 7 to 23%. Which is quite considerable when you think about the sort of growth numbers that the economy is going through at the moment. Let's talk about now the various types of ESOP. There are a number of different ESOPs that you can use in Australia under our existing laws, and certainly in most countries around the world, there are various types of ESOP that are available. Let's have a look at what they are and how we might be able to use them. The first one, which is only fairly new here in Australia, it's only 3 or 4 years old, is what's called a startup plan. These were introduced several years ago, and the government changed the rules to encourage startups to offer equity to their employees. Now, there's a couple of key criteria. Firstly, 4 criteria that the business must meet. Can't be listed on a stock exchange, must turn over less than $50 million, and it must be less than 10 years old. And of course, it's got to be an Australian resident taxpayer. Now, even though they're called startup plans, $50 million most people would not think of as a startup. So they can be quite reasonable sized companies, but they do need to be less than 10 years old to qualify, so that's important. Once you qualify for those 4 rules, then we move to the employee eligibility, and there's 5 rules here. So the key things here are, firstly, each employee can only own less than 10% of the shares. They must be a legitimate employee of a holding company or subsidiary, so they've got to be an employee, they can't be a subcontractor. You can only sell shares at something less than a 15% discount. So if the shares are worth $1, you can sell them for 90 cents, but not for 80. The employee must hold them for more than 3 years, and they must be available to, they're not necessarily offered to, but available to at least 75% of employees with more than 3 years service. Now, if you meet all of those criteria, you do qualify to be a startup under the employee share plan rules. And under those rules, the tax treatment is really advantageous. There is no tax up front. All that is taxed is when the employee exits, they dispose of those shares or options. They get the general, it's a capital gains tax event, and they pay CGT with the normal CGT discount. That can be quite attractive for people to think about. There's obviously no tax on that discount up front, no tax if they're options, which we don't use a lot, but you can use options. But the taxation event happens right at the end of the process when you exit. Then we've got these deferred tax plans, and they've been around for a while as well. Because again, the rules were changed not long ago. To defer tax on an employee share plan, you have to have this thing called a real risk of forfeiture. That's actually not that difficult. That just means that you have the risk of losing the shares under the plan. So for example, if you leave the company before the plan's finished, you lose your shares. Or you could salary sacrifice into those shares. That treats it the same way as real risk of forfeiture. Under any of those models, no matter what you do, the maximum deferral period will be 15 years after you acquire the ESS interest. So you've got 15 years maximum you can defer the tax. Those plans work quite well, but they need to be designed quite specifically as to how that works and what triggers that tax deferral, because that's actually quite an important piece. We've now designed a new structure, and in fact, when I say it's a new structure, I used this originally in 2006, but it's been improved regularly over that time, and it's been updated when the government's changed the rules and tax treatment. Typically, what we're looking for here is a profit share-based plan where the employer can make contributions into the plan for the benefit of the employees. And that simply means the more the business improves, the more profit we make, the more contribution we can make to the employee share plan, and the more equity can be purchased by the employees. This is the ultimate golden handcuff. This is a great way to lock employees in. But when I say lock them in, I don't mean that negatively. I mean lock them in and reward them for their loyalty and their service and for improved performance over time. How does it work? A simple example, we've got a business here called Smith Trading. It's owned by John and Jane Smith. We set up a new structure right in the middle of the screen there called a Smith Trading Peak Performance Trust. It's a unit trust with a corporate trustee. The only thing that unit trust is allowed to do is own shares in Smith Trading, and that's important both from a legal, taxation and compliance point of view, but also important from an employee point of view, because that means that whatever happens in the main trading company is going to happen in the Peak Performance Trust as well. It's the only asset we own. So if those shares go up in value, the unit trusts units are going to go up in value as well. We're going to invite 4 participating employees. Invite's a key word because it's not automatic that people join these employee share plans. It's typical that they would be invited based on performance criteria, etc. Let's have a look at what happens. We've got a corporate trustee on the right-hand side there. We've got Smith Trading on the left with John and Jane, and in the middle we've got our Peak Performance Trust, and in this example we've invited 4 employees to join the trust. The simple model is that we have a profit share model from Smith Trading down to the employee share plan, the Peak Performance Trust. That profit share contribution can only be used to buy shares, and so the Smith Trading Peak Performance Trust uses that money that it received from the profit share to buy equity. The only place that it can buy equity, obviously, is from John and Jane, who are the shareholders in Smith Trading. Now, if we look at an example of how we make this work, same structure, we've got our financial benchmark. So this is an important concept. We don't believe we should share profit from $0. We believe there's a profit benchmark return, which is a return on the equity invested that goes back to the original shareholders. In this example on the screen, it's $500,000. What we've agreed here, though, is once we get to $500,000, we'll share 20% of the amount above that benchmark to the Peak Performance Trust in the middle of the screen. In an example, let's get to the end of the financial year. On the top right-hand side there, our net profit was actually $600,000, so we've exceeded the benchmark. So we are going to pay a contribution. 20% of that excess above the benchmark is actually $20,000 to make the maths easy. Step two, down the bottom left-hand corner, we draw a cheque from Smith Trading across to the Peak Performance Trust. And importantly, that payment is tax deductible to Smith Trading, but it's not income to either the Peak Performance Trust, but it is deferred income, so the income can be deferred for up to 15 years for the employee. So that step's actually quite advantageous from a taxation treatment point of view. Now, obviously, the Smith Trading Peak Performance Trust needs to buy shares. The only place that it can buy shares is from John and Jane, and so it actually writes a cheque to the shareholders of Smith Trading to buy 2% of their equity. We base that 2% on a valuation that gets done every year. The PPT now owns 2% of the shares on behalf of those employees. If a dividend gets paid, there's a distribution next year that will flow through the trust to the employees. And in the same way, if John and Jane sell the company 5 years down the track for $5 million, then the employees will get their percentage share of that sale at the same time. A couple of criteria to put in place. Firstly, how do we get in? We generally have some criteria that staff must meet before they're able to enter. Typically, that might be 2 years of service and maybe some qualification or seniority rules around who can get in. We nearly always have profitability as a performance benchmark within the Peak Performance Trust, but we might also have some other KPIs that we want to drive performance. In some of my clients, we've used safety, we've used sick days, we've used net promoter score, so feedback from customers, in other words, about quality and performance. We've used quality control and scores like that. It's pretty flexible around how you measure the KPIs, but going back to what we were talking about before, they must be business performance related and a KPI that you want to drive within the business to improve the performance. At the other end of the scale, when people exit, we've got two things happening. Firstly, when an employee leaves, they're no longer allowed to be in the employee share plan. They have to be an employee to be in there. That's called a disqualifying event. We then apply a discount, and the discount reduces the value of the shares that they hold based on how early they leave. So if you leave in year one after this plan's set up, it's very common for your shares to be discounted by 80% or more. If you leave in year 8, well, maybe they're only discounted by 10 or 20%. So it's quite common to use this disqualifying discount to reduce the amount the employees are paid out based on timing. The earlier they leave, the less they get paid out. Obviously, at the end of each year, you do need to do, under the tax law, you do need to do a valuation. We actually run these administration programs through our portal where we bring in new members, we manage change of address, update criteria, the contributions are calculated, etc. And we've got a new, it's not new now, it's only a year old, online administration portal where our employees can log in, check the portal and see their statements, dividend statements, the valuation, the documents that go with the share plan, etc., just to save on the administration burden and simplify that process. A couple of case studies and then we'll have a short break and answer some questions. These are clients of ours that we've worked with previously, LJ Hooker Commercial Central Coast, who have an interesting business. They've got residential, commercial, property management and sales up there, as well as some financial services offerings as well. They won the 2011 Employee Share Plan of the Year Award with the structure I've just outlined for you. Ty Blanche is one of the directors up there just talking about improvements in performance across the business. Interestingly, this quote talks actually about referrals internally, not something that we designed into the plan originally, but pretty commonly seen in businesses that introduce an employee share plan where the employees can now see value in contributing to the profit because they share part of it. It benefits them as well. CMAC's an interesting one. I've just downloaded and read a book by the original owner of CMAC Industries, who took over the business after the original founder passed away and built the business up over a period of time, put in place under the, it was actually under the Rudd government Jobs That We Own grant program. They had a grant program in after the GFC to put in place employee share plans for businesses that needed a succession solution. And we changed that business from single ownership or family ownership across to an ownership structure with all the employees. And we saw some pretty substantial improvements in performance. That company has since then now transitioned across to a cooperative. So it's still employee owned, but it's just owned through an employee cooperative, which is a different type of structure that can be used. Then I want to talk a little bit about Umwelt. Umwelt is, suffice to say, one of our success stories. It's a very successful business based up in Newcastle. We do a bit of work up there. We first introduced Umwelt to ownership mindset back in 2014. And that business at that stage, I think from memory, I'm going to get this number wrong, I'm sure, 75 odd employees, maybe 80 at that point in time, growing. They're a multidiscipline professional services firm. They do environmental consulting and sciences. We introduced an employee share plan a couple of years later, 3 years later. Started with 33 employees, originally owning 14% of the equity. That's now gone up. In fact, it's even gone up further than what's indicated on the screen. There's now about 40 employees owning just over 22 or something percent. Really interesting to watch that process over the last sort of 5 years. Dramatic improvement in engagement, culture, performance, profit as well, etc. But an increase also in business valuation due to not just increased profit, but also reduced risk, where employees are now getting involved in corporate governance, in training, in improving the systems and processes within that business. And we'll just...
The success of Umwelt is really about commitment and dedication of our great team and our talented people, and we're nothing without our people.
You often hear a lot about employee share plans. What's unique about our share plan is the percentages of staff ownership that we are aiming for.
By and large, the philosophy behind it is about engendering ownership thinking and ensuring that that thinking affects your day-to-day actions in a positive manner. You're not just thinking about what you're doing or what your team's achieving, but you're understanding that the impact of what you do affects the whole business, and that your colleagues are working together in that same fashion.
We were a bit naive in terms of what the opportunity was out there in terms of employee share plans, and we were referred to Craig from another business advisor at Succession Plus to give some advice about what the opportunity might be.
My initial response was good. I felt it was a great idea for us to move towards. I had reservations about certain aspects, but any concerns were allayed pretty quickly. There's always been a willingness to answer questions and to give staff at all levels the opportunity to probe different aspects of it to increase their understanding.
Similar to our business, the best part of dealing with Succession Plus is their people.
I personally get on well with Craig. I just found that he just tells it how it is, and he's very approachable. He was really good at targeting and tailoring what we needed based on who the person was.
It's been a learning process on all counts along the way, trialling things that we thought would initially work, and then when we got either legal advice, we've changed things or tweaked things here and there. When we did find Succession Plus, Craig obviously came on board, and from that point of view, that was a good mix for us because that was the sort of plan that we were looking for. So there's been a long process about putting the governance in place that would make the employee share plan work. We chose to go down the road of getting an ATO ruling so that there was no risk on the employees' side at all.
They were quite deliberate in making sure that as a business we were ready, because rushing these things is where I have seen and heard of the culture challenges where you create quite competitive teams that work against one another in a way, whereas the speed that was integrated and developed for us meant that we were ready.
In my view, it's not enough just to put an employee share plan in place. We could have just done all the legal documents, signed them all off, and there's the employee share plan. Let's leave it at that, and hopefully that'll all magically work. That's not actually the case. It's part of the recipe.
And I was really pleased and proud that the loyal and committed team stayed with us on that journey. They trusted that we were going to get there, and we certainly did in the end. And then we were really pleased last year to roll out our employee share plan and to now have more than 30 people as current unit holders in the employee share plan trust.
I think fundamentally for me it makes me feel like I'm effectively an owner of the organisation, and the actions I undertake day to day have broader ramifications for the company's success.
as we all take more ownership, that'll improve the sustainability of our business, and our clients can know that we'll be here in the long term.
We've already got employees thinking like business owners. A lot of you have already come up with ideas or feedback or input that is a little bit above and beyond what you'd normally come up with as an employee, because you're thinking about it from a business owner's point of view.
There's no doubt that having the employee share plan in place is important for us to be able to compete with our range of competitors for great talent.
We find empirically through our survey results that the ESP component of Umwelt is one of the reasons why staff are being attracted to our business.
Generally, it's been very positive, and particularly, you know, when dividends start to get paid out, which has already happened. We're through our first payment. That was well received, as you can imagine.
The basis of ownership thinking and ownership mindset is that each individual takes on a personal interest and a role in the success of the business.
Okay, well, hopefully that has been fairly helpful and interesting. Time now for some questions, and I'm happy to answer pretty much any question you like in terms of employee share plans. I've already got a couple on the screen there. The first one's from Brian around valuation formula. And it's always a question we get asked: how do we value businesses and what makes a business valuable? And like most assets, there are really two key components. The first one is performance and ultimately profit. If you're looking at any asset, there's two components: risk and return. The return in a privately held business is typically profit. And so we need to look at profit and work out what is the profit and what's a realistic, ongoing, sustainable profit model for that business to have. The second part of it then is risk. And in all assets, whether it's a property, the share market, or privately held businesses, there will nearly always be risk. And so what we need to do there is determine what do we need to look at in terms of risk within the business. What are the things that are causing us concerns or causing us trouble within the business? And how do we manage that risk going forward? What is it that we need to actually look at in terms of risk minimisation to make sure that we're actually getting the best possible outcome for business owners? And that valuation combination is really around how do we calculate the risk versus the return, and that gives us what's called a multiple. Therefore, we use a multiple to value the business. So you often hear people talking about, oh, that business makes $500,000, and on a multiple of 3 or 4, that means it's worth $1.5 or $2 million. The multiple is largely a relationship to risk. Other questions? I'm very happy to answer them. All you have to do is type them in. There's a little box on the top right-hand side there with a little chat symbol next to it. If you've got questions, please go ahead, and I'm happy to answer them, as I said, as we go. I've got another question. Okay, so typical cost to implement an employee share plan. They can be anything from $8,000 to about $30,000. $8,000 is typically the cost to implement a startup type plan, where you've got the startup employee share plan, fairly simple standard set of rules, not a lot of flexibility around what can and can't be done there, but they're also fairly quick and easy to implement. So that's quite interesting. The second part is just around the complexity of the plan. So if you've got a company with multiple offices and a whole stack of queries, etc., and you've got people in different departments, etc., then we need to start to think about how do we actually value that business? How do we make sure that we get the design of the plan right and we deliver the content correctly to make sure we match the outcomes that the business owner and the employees are looking for? And those more complicated plans, typically that's a 3 to 4 month process to implement that. Typically costs about $20,000 to $25,000 to implement. We've got another question from Shannon talking about the video. Curious with some of the comments, they sounded concerned or perhaps even some negative feelings toward the ESOP, but once implemented, they were happy. And that's quite true. I think that's very true. I think the main thing is people don't understand employee share plans unless they've been in one before or they've worked in a listed company where there are a lot of employee share plans. Then that can be quite difficult, quite interesting to introduce that kind of chain. People are often concerned about the liability or the risk for themselves personally. There isn't any, but they're originally concerned about that and need to understand how that works. They're a little bit more complicated, these structures. So, you know, there's some legal requirements, there's some taxation issues to be concerned about. How do we get dividends? Some employees have never owned shares, received dividends, franking credits, etc. So I think your comment's right, Shannon. I think there are some concerns up front. But again, I think I go right back to the start. It's all about education. The more you can educate and explain to people what happens, how does it work, you know, what are the key things you need to know as an employee to benefit from the plan and to use the plan. As you can see now, and certainly if you talk to people at Umwelt, that video's made about a year ago. They're all still in the plan. It's going very, very well. In fact, we've expanded the plan. There's more people in there owning more shares. So it's a very positive experience over time. But I think you're right. Up front, it can be a little bit concerning and confronting around the change. So I hope that's answered that for you. Next question. What would be the starting point for someone who's considering this? Yeah, what do we need to work out? The starting point is always evaluation, and there's two reasons for that. Firstly, it's required by law, but that's not the main reason in my opinion. The first thing is you need to understand where you're starting from, what the business looks like, what the value is, and how you would actually integrate an employee share plan over time. As you saw with Umwelt and the NPG example, they take a few months to implement properly. And so the first thing to do is make sure we understand exactly what we're dealing with. What does the business look like? How many employees? What's the valuation? What percentage of equity do we sell down? What happens to the business over a period of time? How long does it take for the owner to exit? Who's going to take over running the business? The whole stack of questions up front. So the starting point would be to look at the financials, but very quickly after that, the financials would then be a non-financial analysis. What else in the business do we need to know and understand to make it work and to help design the plan so that it actually delivers the outcome you're looking for? Because business owners are often looking for different things. Some are looking for an exit strategy and to build up the value of the business, to build up profits. Others really want to retain their legacy and make sure the business continues on after they leave or retire. Others are looking at how do I build this business up to sell it in 5 years' time. That can cause some differences in the way that the plan's designed. But the starting point, valuation, upfront, we call it an insights report. If you wanted to email me later, I can send you some more information on that, but I hope that's been answered sort of reasonably to give you a bit of an idea. Another question from Brian, what happens if the major shareholder dies? That's a great question. So on the way through, obviously, and use Umwelt as an example, not that we want anything to happen to anybody up there, obviously, but we've got a business up there that's now got 30 plus shareholders. They now all own small parts of equity, but there's still a founding shareholder, the MD up there, Barbara, owns the majority of the equity. She's still sitting at above 65, 70%. There is a risk if something happens to Barbara in the process, and we as a board, we talk about that all the time, and we talk about, you know, what that risk entails. There are obvious things to do. Firstly, the employee share plan joins up, it signs a deed that joins it up to the existing shareholders agreement. So every business should have a shareholders agreement. And as part of that shareholders agreement, you need to think about unplanned events. What happens if someone gets hit by a bus, someone can't work anymore because of illness or anything else? Often that's documented in an agreement, which is a buy-sell agreement that talks about what happens. And typically that would be funded through insurance. If you get to a reasonable sized business, you're generally going to have an insurance policy that covers that off, because it's unlikely, to use Umwelt as an example again, it's unlikely those employees are able to write a cheque to buy the other 60% of equity straight away without some kind of external funding. So that's obviously something that we consider as we implement the employee share plan. Next question from Anna, is there a guideline of what business would be considered too small to implement this? That's a really good question. I've got at least 6 or 7 of these plans in businesses with just 1 employee. So if you think about your business or your client's business, if you're advising someone, really where you've got at least 1 employee that you want to lock into the business in terms of retention and reward and motivation, then it's not too small. The cost, if you think of typically the data that talks about employees leaving a business, typically that cost is somewhere around 40% of a salary. So if you've got a $100,000 employee and they leave, it's going to cost you $40,000 roughly by the time you recruit a new person, train them, bring them up to speed, etc. The idea here is we avoid all of that by retaining those people within an employee share plan. So I've certainly got clients who are, you know, turning over $500,000 and have one employee in place. That's not too small in my view to make this work. And the important thing about the employee share plan is we can add employees to it as we go. It doesn't have to be we put one person in and that's the end of it. We can continually add employees on as time passes. So I hope that's helped there. The next one, starting point, we've already covered that one. And the last one is around ongoing. How does the, okay, so ongoing management of the employee share plan, I guess there's two key parts to that. One is the business itself and the corporate governance structure. So in most of the clients that we work with that are of a reasonable size, we've now implemented a board structure. Often we bring in an executive, non-executive director, external third-party directors who can come in and sit on the board and advise the business. Because what we're doing then is building up some structures, discipline and accountability around the business and the performance, etc. The other side of it is, in terms of managing the plan itself, we do the administration and manage the plan. It's an accounting style function. It's not really accounting work, but there's a unit register to maintain. You do have to do a valuation every year. That's quite important from a taxation point of view. And then you have to also think about managing just the compliance regulations. If an employee changes address, if someone leaves the business, someone new comes in, you have to manage all of that as well. So I hope that's answered that question for you. I'm very happy to answer questions offline separately to this. You can simply email me or just send through a message, and I'm very happy to talk to you. All my contact details are on our website. My email is just cwest@successionplus.com.au. If you do have questions or you want to find out more about an employee share plan, please reach out. Happy to help you. There's ebooks and white papers on our website. They're all free. You can go on there and download them anytime if you like, and hopefully that will provide you with some more information. I hope that's been helpful. We're just short of the hour period, so I will wrap up now unless there are any more questions. Thank you for attending. Hope that's been helpful, and please feel free to reach out if you want some more information. I'm happy to help if I can. Thanks for attending, and we'll look forward to seeing you at the next event.